Today on InvestTalk, we went over some less than perfect advice from Dave Ramsey, answered questions on KRO, and shorting stocks, and then ended the day by talking about some risks within the property market.
This is InvestTalk. Independent thinking, shared success.
Now let's shift gears and touch on my main focus point today, which is about debunking Dave Ramsey's stock market claims. Because, frankly, assuming that you can get 12% return year over year, and some of the other things he claims, is a little bit unrealistic. And so, for those of you who don't know, Dave Ramsey is one of the most popular financial gurus in America. He had a pretty volatile career, including building and losing a $4 million real estate portfolio by the age of 30, and that led him to develop a personal finance philosophy that is rooted in discipline. Today, Ramsey's net worth is estimated to be around $200 million, and he shares his techniques with millions of followers through books, radio shows, and financial counseling. Now, one of the cornerstones of his investing philosophy is his recommendation to avoid individual stocks and instead focus on mutual funds. He suggested investing in a mix of growth and income funds, growth funds, aggressive growth funds, and international funds is more beneficial, and tells his listeners to look for funds with strong track record of outperforming the S&P 500, emphasizing long-term returns and consistency. But while he encourages investors to find these top-performing mutual funds, he doesn't really specify which funds to buy or how to find them, making it harder for the average investor to follow his advice. And that's kind of not the only issue I have with some of the things he says. One of my big issues was a controversy that was stirred recently where he recommended maybe an outrageous retirement withdrawal percentage. He suggested an 8% withdrawal rate from retirement portfolios, which is double the standard 4% rate most financial experts advise. Morningstar, big critic of that, backtested his recommendation and found that retirees following an 8% withdrawal rate could run out of money within 20 years in 32% of test cases. That is far too high a likelihood of running out of money in 20 years. Financial advisors warn that such a high withdrawal rate could leave retirees financially vulnerable, especially during market downturns, right? It's not just about having the money, it's about when you need the money. Despite these concerns, there's no question that his broader personal finance philosophy, avoiding debt, living below your means, and consistently investing in diversified funds has helped thousands of people. I agree with all of those things. But when it comes to specific investment advice, it's important to proceed with caution. As always, it can be helpful to partner with a financial advisor who can help you manage your risks, achieve your long-term goals, and tailor a plan to your specific financial circumstances. So what's the big takeaway here? Well, Dave Ramsey offers some solid foundational principles. Not living beyond your means, avoiding debt, planning for the long term. But when it comes to his specific investment recommendations, it might not be as simple as reliable as they seem. As with anything you hear from any of these financial gurus, take it with a grain of salt. Do the due diligence that is required and that you owe to yourself. Look beyond what is said on face value, what anybody says to you. And so I just want to emphasize it again. This is one of the most personal choices you make because it's about your life. It's about your loved one's life. It's about your financial future. So anytime somebody comes with something that sounds a little bit too good to be true, it probably is. Do yourself a favor. Look deeper. Let's talk about the market today. U.S. stocks were mostly higher, ending near best levels after reversing some midday weakness. The Dow down 23 basis points, the S&P 500 up 45 basis points, NASDAQ up 84 basis points, and small caps nearly flat, down 2 basis points overall. Now, today's modest rally really came off of Monday's session that saw the Dow, S&P, and NASDAQ all up over 1% following what was the biggest S&P pullback last week since the Silicon Valley Bank crisis. Big tech, a lot better today. Amazon, Tesla, the big standouts. Software outperformed following Oracle's results as well. Other outperformers included utilities, food, building products, banks, energy, transports, autos, travel, and leisure among the worst performers. That's banks, energy, transports, autos, travel, and leisure being the worst performers of the day. Treasuries looked a lot firmer with some curve steepening, especially the 2-year at 3.6%, which is the lowest close since September of 2022. The dollar index was up 10 basis points. Gold settled up 40 basis points. WTI crude ended down 4.3% at its lowest levels since December of 21. I wonder what that will mean for our oil and gas roundup at the end of the week. Copper finished down 1%. Stocks mostly extending that Monday rally that was chalked up to an oversold bounce, while today also saw some rotation back into tech and into semis and into that AI trade following a well-received Oracle earnings. However, in spite of all this, a few headwinds are still in focus, including some underwhelming banking sector updates. Goldman Sachs notably saying that they would expect some losses from unwinding some of their trading positions within their commercial division. Weak auto guidance out of Europe was also bad, and softness in commodities prices broadly. Path of least resistance has recently, for the past week, been lower on the back of negative seasonality, election uncertainty, the waning buyback window, given the upcoming blackout period, and overall a pickup in growth concerns from macroeconomic data. The next big catalysts are tonight's presidential debate and tomorrow's release of the August CPI. PPI and claims will be coming out on Thursday, and the preliminary University of Michigan Consumer Sentiment Survey, which includes inflation expectations, will be out on Friday.
This is Art from Tucson, calling in about a small cap value specialty chemical company called Kronos Worldwide Inc, KRO, and I'm wondering if it's a good value here. Can't find a lot of information on this stock. Wondering what you think about the company and if this would be a good buy point. Thanks. I'll listen on the podcast. Bye.
So Kronos Worldwide Inc, ticker KRO, is a titanium dioxide pigment manufacturer. And so their products are used in coatings and inks and plastic, paper, paper laminates, all sorts of products, fibers. And they've had a rough time over the past 5 years, as you can see right here in their performance relative to the S&P 500. It has not been good for quite some time. Now, year to date, they're up 5%. Over the 3 months, though, it's been a pretty rough 3 months. Why has it been a rough 3 months? Well, we tell you this all the time, as investors tend to love the idea of a juicy dividend, but dividends are not set in stone. And so going back about a month ago, well, they announced that they were cutting their dividend from 19 cents per share to 5 cents per share. That is a significant decrease in their dividend. And so with that, the market obviously said, well, the reason why they are not able to pay their dividend is because they're not doing well. And the reason why they're not doing well is because they really have not grown as a business in terms of revenue over the past 5 years. 10 basis points is their annualized growth rate over the past 5 years. And so even with the drawdown over the past 3 months, even with that relative underperformance for the past 5 years, it's still a consensus underweight target, even at $10. It has short interest of around 5% right now. It's a $1.2 billion market cap company. It's got $500,000 of debt. It's got about 136 million cash on hand, so really only $300 million worth of debt. But the main story here is there has not been really strength within this company for quite some time. In 2023, it lost money, and its cash flow has been trending downward for the past couple of years. So I'm not seeing a lot that I like here. I think it's a consensus underweight for a reason. And overall, anytime a company cuts its dividend, it is generally not for a good thing. So I would have to pass on a Kronos Worldwide, that is ticker KRO.
I want to talk about dollar general, and thank you for taking my call. It's good. So do you think after last result, it's fall down almost 30 to 40%. This is a great price. Or do you want to wait for some more time? I would like to take your input. Thank you so much.
Yeah, well, thank you for calling, because we always appreciate those live calls. I love talking to you guys live. And so taking a look at Dollar General, I think they have a lot of debt on their balance sheet. They have $18 billion worth of debt on a $17 billion market cap company. And it's true that it has fallen down. This is the recent drawdown over the past 3 months of 36%. And so for me, whether I'm ready to get into this name is more of a question of what has been driving the drawdown. And so when you see Dollar General specifically, and I think I mentioned this on a previous show, when consumer spending is pared back, you see these names tend to not do well. But when it's a Dollar General and a company like Dollar General, you have to ask yourself, what does that mean for the economy and consumer behavior broadly, right? So when overall the ability of the consumer to spend falls, you'd actually expect companies like Dollar General to do better than even companies like Walmart, which tends to have higher prices, but lower prices generally, but they're still higher than Dollar General. And so for me, I think it's a question of what is driving recent forward guidance, what is driving recent earnings results. Were they correct in analyzing what was driving that? I'm not sure. So I think for me, it's a time will tell. Is it that their consumers are being asymmetrically hurt in this economy? That could be the case. Is it that everybody is being hurt symmetrically within the economy in terms of their ability to spend? That could be the case as well. But looking on it, even ignoring the reason for its fall in price, what I see is a company that has not a lot of growth over the past 2 years. And I see a company whose cash flow is kind of flatlined a little bit, a company who has a lot of debt on their balance sheet. And so even ignoring recent trends, even ignoring the context of what's happening there, I think for me, it's still a wait and see and keep on my watch list. I'm not convinced that there isn't more downward movement in store for this company right now. I mean, it broke past any level of support it had over the past year. So I'd keep it on my watch list for now, but I think I need to better understand what is driving that and what that means for overall market trends. Thanks for calling. I hope you've been telling your friends and your family that our InvestTalk audio podcast is on YouTube. And when we get questions, we like to answer them. And so this question about CHRD, it says, hey, Brett from New Jersey here. I received shares of Chord Energy, CHRD, when they merged with Enerplus in May. The price has dropped substantially since that time. It seems to still be in a downtrend, but would you consider adding to the position if you were me? Maybe wait until it breaks its downtrend. If you could do an overview of Chord, I would appreciate it. So let's look at Chord a little bit before we head into the break. And so Chord Energy, as Brett mentioned, just went through a merger with Enerplus. And so shareholders of Enerplus received shares of Chord. And it is an exploration and production of crude oil, natural gas liquids, and natural gas company. And so what does that mean? Well, it means that its sales are typically going to be directly correlated to the commodities that it. And so anytime you look at a energy company like this, you have to understand that it is a victim of the times, right? Its price movement is primarily predicated upon the movement of the underlying commodities. And in this case, oil has not been doing well. And so when oil doesn't do well, this company's not going to do well from a stock price performance perspective. But from a fundamental perspective, the company's doing great. Increase in cash flow since 2021, very little debt. It's an $8 billion company. It's got $1 billion in debt. Its profitability looks pretty solid to me. In 2021 is 12% net margin, 28% last year. Gross margins are around 35 to 40% for the past 3 years. And so with all of that being said, I don't see any reason why you would want to sell this company. The downtrend is because it is a victim of its environment. It is because the commodity itself, oil, is not doing well. And when oil goes back up, which presumably it will because oil is an important part of the industrialized economy, it's currently at its lowest level since 2021. We talked about that at the top of the show. I think that Chord will likely do well. And so for us personally, we're looking at energy names right now, reinvesting in some energy names. I think Chord is probably a good one to be on that list. So I would give Chord the thumbs up. Thanks for the comment.
I am calling today about Expedia, ticker symbol EXPE. I had this on my watch list, and I was wondering what you thought about the company and if you thought there was a good entry point. It is a little pricey. Let me know your thoughts. Thanks. Bye.
So Expedia is a household name, I would say. They own a bunch of different brands that deal with booking flights, hotel rooms, experiences, travel, not just for consumers, but also for businesses. One of the funniest things I think about Expedia is that people tend to compare prices on their various products, like their kayak or Trivago. I think they own kayak. And essentially you're just comparing prices between the same company, right? Anyway, and so when would you expect Expedia to do well? Well, you'd expect Expedia to do well when people have money to spend. And in spite of some of the talk of a recession on the horizon, every single holiday this year has been the busiest it has ever been. The airport's the busiest it's ever been for people going on vacation and for people leaving and people flying. And the people that are flying and people going on vacation have to book some way. And a lot of them have used Expedia. Now, year to date, they're down about 13.5%, 14%. In spite of that, over the past year, they're up 20%. And one of the reasons why they're down is primarily because of a CEO change that was announced in May of this year. And that CEO change saw a drop-off from which they recovered a little bit. There's also a fall-off in February due to some expected decrease in fiscal year earnings. But in spite of macroeconomic data that shows a deteriorating economy, bookings have been pretty solid. It's been pretty resilient. And so looking at all of this, right, they're finally, after last year, back above their pre-pandemic levels. Makes sense. Nobody was going on vacation during the pandemic. Keeping all that in mind, I mean, from their balance sheet, it looks fine. They got $6 billion in debt on a $17 billion market cap company. They have a little bit of short interest out there, around 6%. The reason being probably because people foresee that at a certain point, consumers will not be able to spend on travel as much. But with that being said, I mean, the company's in a fine position financially. The company's growth has been pretty decent. Again, you have to remember that their revenue fell in half in 2020. So from 2020 until now, their revenue grew from $5 billion to $13 billion last year, projected to be $13.6 billion this year. Now, with that being said, they're on a little bit of the expensive side of things based upon, where they've been. If you look at their book value, about 19 times book value, but on price earnings, they're about 10 times. So, I think there might be a little hesitance rather to purchase shares in Expedia and names like it, because people are anticipating a big drawdown in consumers' ability to spend. There's just not a lot of evidence that that's been the case yet. But I think that's probably why there's a lot of short interest out there. I would wait a little bit to get out of the September seasonality into the fourth quarter. Maybe get a little bit of little bit more of an idea of how deep the pain has been within the labor market, how much that is going to affect consumers before I get into a name like this. But overall, I mean, it looks relatively cheap to me. It's run well. It'll be interesting to see how the new CEO does at the helm, but it's been a surprisingly resilient business, and it may be resilient going forward. Let's go ahead and play two in a row.
I had a question about shorting a position. It's something I've never done, but I was considering learning and was also considering potentially doing it in the commercial real estate sector, like commercial REITs. In addition to knowing your opinion as to whether now might be a decent time to short some commercial REITs, I also thought about the timing and potentially trying to cover them during a dividend payment, if that makes any sense. I'd love to know your information and feedback. Thanks for the show. Bye-bye.
So when you short a stock, what you're doing is you're borrowing it from somebody that owns it through your broker, who facilitates the transaction. And at a certain point, you'll have to cover, which means buying it back and returning it to the person that lent it to you, person or institution that lent it to you. And so the risk there is that the price does not go down. In fact, the price goes up, and what you're losing is the difference between what you sold it for in the first place and now what you have to buy it back for to return it to the person who's lending it to you. Now, with respect to commercial real estate, the time to short commercial real estate is definitely not as interest rates are falling. is definitely not when debt financing is becoming cheaper. So I would advise against that. I think shorting is also something that you should primarily do over the short term. When you get too much shorting activity, you have the risk of a gamma squeeze, because if the price moves up too quickly, you have that short squeeze rather. If the price moves up too quickly, people will have to buy back, and that buyback will move the price even further, and more people have to buy back. So it's a dangerous game. Overall, I think when you're investing in the stock market long term, you want to be long things. If you think that in the short term prices might go down, that's fine, but I would recommend and warn you against long term shorts. Thanks for the call. The excitement around artificial intelligence may be masking deeper issues across the broader technology sector. While companies like NVIDIA and Microsoft have seen massive share price gains, largely thanks to their early positioning in AI, many tech companies are just still facing challenges. In fact, some investors argue that much of the tech industry remains in a recession, struggling to regain momentum after a slowdown that started back in 2022. Tony Kim, who's the head of technology investing in BlackRock, points out that outside of AI, there hasn't really been much growth. Traditional tech sectors like software, IT, consulting, and electronics production are facing weak demand and are still dealing with the hangover from really overexpansion and inventory issues that started during the pandemic. Dustin Moskovitz, CEO of Asana, summed it up last week when he said that many tech companies are still unwinding from the overhiring and overspending that happened during the early days of the global pandemic. This, combined with economic uncertainty and the unpredictable impact of AI, has left many companies scaling back their forecasts for the rest of the year. Recent financial reports highlight the extent of the struggle. For most large tech companies, growth has slowed. Companies in the S&P 500 IT subindex, so that's going to be IT names, large caps within the US, saw revenue increase by an average of 6.9%, which sounds great over the past month, or rather over the past 12 months, averaging 6.9%, but compare that to 10%. That was the average over the past 5 years. And it's even worse for small caps. Small caps, which have not benefited from the boost of AI generally, are facing even steeper declines. In the Russell 2000 index, tech was the second worst performing sector, with revenue down 6.1% year over year. You wouldn't expect that given the narrative about AI. Even within sectors that have benefited from the enthusiasm like semis, some business lines are still struggling. Applied Materials, a chip equipment supplier, reported very strong demand driven by AI and data centers, but also noted a lot of weakness within auto and the industrial markets. So where does that leave the tech sector as a whole? Well, some investors are predicting a shift in attention away from big AI stocks, something that we didn't really see over the past couple of days, and towards other sectors like financial services and industrials. While AI has been the dominant theme for the past 2 years, it's likely that it will not be the only thing driving growth moving forward. So while AI has fueled massive gains for a few key players, the broader tech sector is still facing significant challenges. And so investors will need to be cautious, as the success of AI-focused companies may not really be enough to lift the entire industry out of its prolonged and current slump. Now let's head back over to our YouTube question bank and answer a question that came in earlier. It says, "Hi, Justin and Luke, Matt from England here. Looking at Assurant, ticker AIZ. I hold a small position and currently up 10%. What do you think of the company long term?" Well, Assurant, again, ticker AIZ, engages in the provision of lifestyle and housing solutions for consumer purchases. They operate through their global lifestyle brand, global housing brand. And their lifestyle segment offers mobile device solutions and extended service products and related services for mobile devices. Anyway, so let's take a look at this company's balance sheet. Well, they got $2 billion in debt on a $10 billion market cap company, which makes their debt to equity about 43%. That's nothing that's too crazy. They pay a 1.49% dividend, and their payout ratio is only 23%, which means they still have a lot of room to go. The dividend's not really under threat. They have very minimal short interest out there. And their revenue has grown by about, looks like 33% over the past 5 years, not on an annualized basis. It's roughly about 7% on an annualized basis over the past 3 years, which is certainly good for a company that's insuring and protecting mobile devices and appliances. That's something that honestly is more than I would expect. Taking a look at their forward-looking price earnings, it's about 11 times, so well within their 5-year average, not something that appears to me to be overvalued. That all looks good. I think generally speaking, I expect that a company in this type of business would have a little bit more debt than they do have. That's a pretty fantastic debt to equity ratio, and their cash flow has been improving over the past 5 years. So, overall, I think when you're looking at this type of business, what you're worried about is the risk profile. And the business segments are pretty concentrated within global lifestyle, but the profile of the risk associated with having to pay out on these policies is not going to be too high. So, overall, I think the expansion of the business has been pretty good over the past 5 years. Year to date, it's up 13%. It's up 40% in the past 52 weeks. It doesn't look to be overvalued for me. So, at least in the short to medium term, I think it's probably safe to not have to sell this company right now. Thanks for the comment. Let's grab another caller question now.
I'm calling about WEC Energy Group, ticker symbol WEC. I wanted to get your thoughts on this particular company, the fundamentals and technical analysis as well, and if at what price point you would consider adding it to your portfolio. I'll be listening to your response on the podcast. Thank you.
So WEC is WEC Energy Group. It engages in the generation and distribution of electricity and natural gas. It's a utility company, and it has been doing particularly well, as a lot of electric utility companies have, not because people are so much worried about the economy, but because we talked about this maybe last week or 2 weeks ago. That is because of the demand for electricity from these AI models, from investment, from CapEx, from all these tech companies, has really boosted these stocks in a way that it has moved them outside from how they traditionally tend to outperform the market. And so this is an example of that as well. Revenue growth looks pretty solid over the past 5 years. Their debt levels, decently high, but you expect that with utilities. I would say overall, what is driving this company higher is what is driving a lot of utility companies higher. So I would give it a thumbs up given the dynamics of what is affecting the industry as a whole, and it doesn't frankly seem too overvalued, trading at a price to book about 2.5 times. Plenty good enough for me. Let's talk a little bit about something that has been on top of mind for quite some time, and we've mentioned it from time to time, and that is offices. Now, American offices are breaking records once again, but this time it's not something to celebrate. Office vacancies have hit a staggering 20.1%, the highest since 1979, according to Moody's. And as vacancy rates rise, the ripple effects are being felt across the commercial real estate market, particularly in office spaces. Now, the situation's pretty dire. In July, 8% of office mortgage securities were delinquent, marking the highest rate since 2013 and even surpassing long-troubled retail property loans. Loans that were taken out during the pre-pandemic era when interest rates were much lower are now coming up for refinancing. And with today's higher rates, many property firms are finding it nearly impossible to refinance. And that's putting a lot of financial institutions in a pretty tough spot. The mantra from the 90s, when property saw a downturn as well, was stay alive until 95. Now it seems to be stay alive until 25, with hopes that the Federal Reserve will cut rates enough to make refinancing more viable. But even if rates drop, there's a larger problem here. Remote work has changed the landscape. Last year, a third of workers spent part or all of their time working from home, and downtown districts have been hit the hardest. There was a great restaurant across the street from where I live that used to rely on office workers. A restaurant that had been open in Los Angeles for 10 or 15 years, a well-known restaurant that had to close because even coming back from the pandemic, not only did costs get more expensive, but their clients left, their customers left. In San Francisco, for example, 32% of office space is empty. In Austin, 23% is their vacancy rate. So what happens if holding out for better times doesn't work and foreclosures start to become the norm? Well, there are three groups that could be left holding the bag. The first is investors. About half of all commercial property loans come from institutions like insurance companies, private equity firms. These investors knew the risks going in, but they may be in for significant losses. Secondarily, big banks are likely to feel the sting. They're often the ones lending for large, shiny downtown skyscrapers in top-tier cities, and their delinquency rates have skyrocketed compared to smaller banks. But because these banks are so large and have diversified portfolios, diversified lending bases, diversified deposit bases, and honestly a lot more regulatory scrutiny, the impact might not be as noticeable. So where's the real concern? Well, the real concern lies with smaller and regional lenders. These lenders, these banks, these regional banks are really the lifeblood of the economy. They're the ones that fund small businesses. They're the ones that fund these smaller properties, the ones that fund local economies. For these banks, commercial property loans make up a much bigger share of their lending portfolio. In fact, according to S&P Global, more than 250 banks have loan portfolios that regulators consider risky due to their heavy exposure to commercial real estate. These smaller banks lending to suburban offices and smaller businesses are more vulnerable to a downturn because of the concentration of their assets. While they're not focused on those big skyscrapers, they're still at risk, and a major wave of defaults could leave them in serious trouble. And so while the office market is struggling and regional banks are feeling a lot of pressure, probably the most pressure they felt since March of last year, the general consensus, and I tend to agree with this, is that it won't really be a catastrophic blow to the financial system. Workers logging in from home may have dealt an economic blow to the office real estate market, but it's unlikely to be enough to sink the broader financial system. It's unlikely to be enough to be a systemic contagion like we saw in 2008, but that doesn't mean that there can't be local areas that are devastated by what could be a pretty bad regional problem. Now, before we leave, I want to remind you once again that we are presenting a new InvestTalk Wealth webinar. From time to time, Justin and I sit down and create a presentation for all of you in hopes of going beyond what InvestTalk offers and do a more detailed dive on one subject to help you achieve your financial goals. This one will be about enhancing your retirement savings and effective strategies for managing your 401k. It all happens online Tuesday, October 8th at 11 a.m. Pacific time. If you're interested, go over to investtalk.com, sign up for our upcoming wealth webinar. Remember, it's on October 8th. It's free to attend, but you must register. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family members about our free podcast downloads. You can get yours and they can get theirs at iTunes, Google Play, and Spotify. Please be sure to rate and review us on iTunes. And even if you want to, come check us out on YouTube. We have a YouTube channel that is InvestTalk with 2 T's. We release all of our podcasts in video form. You can look at our charts. You can look at our air quote beautiful faces. Come check us out. Independent thinking, shared success. This is InvestTalk. Good night.